Hello everyone, welcome back to my channel. Today we're going to start a new topic, which I call machine learning. Not machine learning, but machine learning. The focus of this topic, or the series of this topic, will be how can we apply mathematical models and statistics, the big data analysis on financial markets, and to have the trades automated and make profit from that. It will be a big topic, but we'll start from future markets and forward markets and interest rates, some of the basic foundations of the financial market, and we'll do that step by step. And eventually, after maybe 100 series, we're gonna have a pretty good knowledge of doing that. So let's begin. So forward contracts or future contracts, what are they? Forward contracts are usually traded by financial institutions where if you want to buy the asset, like sometimes later, you negotiate with the other side of the partner of a specific price, and it will be delivered in the future time. And so that's forward contracts normally. That's usually traded out of the a central entity. It will be always traded. In most cases, it will be traded partner by partners, institutions by institutions, and futures is similar to forward contracts. Future contracts are traded in financial centers Chicago Exchange, and it was this other the clearance was made by the centers, and there will be daily settlements, there will be margin calls, and so on. So I won't go too much details on that. There's many resources on those financial concepts online and other books. So and the topic here is now about those financial concepts. So let's continue from there. So the first thing is how does the market works? How's the market price the forward contracts? I'll simply call forward contracts because future contracts are similar. So we start from the simplest way. So if the pricing of the forward contract was inefficient, then there will be arbitrage opportunities, and no one in this contract, that involved in this contract, wants to be being taken advantage of that. So let's begin. How do we start from this simplest model? So let's say, assuming that we have another investment from banks or from central banks or something that will provide us a risk-free interest rate on, then and if the contract will mature at 10t after time t, then the forward price of this contract is written in this formula, where S0 is the spot market of the underlying asset, and e to the power RT is the continuous compounded interest rate you can earn if you invest this money on a currency market. So S0 times e to the RT means that if you borrow S0 amount of money, and you have to pay for the bank for continuous compound rate R of, then this is the money you're gonna eventually pay back, and that price has to be equal to, after 10 times t, that when you sell this, or you sell this contract, you gain the value F0. It has to be equal to what you borrow, and which including the interest rate. So what happens if it's not equal? So let's say F0 is greater than the money you borrow plus the interest rate, then the arbitrage happens. You can just buy the asset from the spot market and short the forward contract. You can just short a forward contract. You borrow the money, you spend S0 times e to the RT, and then when you sell it for a higher price, so you get a profit of F0 minus S0 times e to the power RT. The other opposite is the same. There's also arbitrage. If S0 is less than S0 e to the power RT, then the arbitrager can just short the asset from realized at the spot price at S0, invest the earnings at a risk-free interest rate R for a T period of time, and long the forward contract after T period of time. Use the asset realized from the forward contract and return to the borrower. So you get a profit for S0 to e to the power RT minus F0, same as the other direction. So an asset that could produce, so there's many kind of assets. There's investment assets, there are commodity assets, there are consumer consumption assets. So let's say an asset that could produce income, for example, or a stock that could produce dividends, or a coupon that will bear a coupon, or a bond that could give coupons. So those are examples of investment assets. So suppose this is an investment asset will provide an income of C1 at maturity T1. Well, T1 is less than a time T, given, and we have another is that the risk-free interest rate is RC for T1 period of time. The present value of income will be C1 times e to the minus RT, discounted. So after T1, the T1 amount of money can be repaid back to the borrower. Only the rest of money, S0 minus C1, is borrowed at interest rate R, which gives us the formula for forward contract price. So that will be S0 minus I1, which is borrowed from in a different interest rate, times e to the power RT. And it's the same if let's say it's a bond, and it will produce coupons for a couple of period of times. Let's say produce C1 at T1, C2 at T2, and Cn at Tn until the time T. Then assuming the risk-free interest rate for each Tk provides, let's say, RC1 to RCn, then the present value of those lump sum incomes will be Ik equals to Ck times e to the minus RCK Tk. The price of the forward contract will just be this one. So this is the same. It's just here we are minus 1 I, and here we're minus a sum of I. So that's how we can price for investment assets, and the same principle is similar to this one. So if S0 is greater or less than this one, then there's arbitrage opportunities there. An asset with use is another kind of investment asset where instead of producing a coupon, it will generate values from let's say a continuous compounded interest rate. So if the underlying asset of a forward contract provides a known yield Q, which is continuous compounded, of the asset price at 0, which is the current spot market price. If the risk-free interest rate to borrow money from is R, then the actual interest rate applies here, it will be R minus Q. So the forward price should be at 0 times e to the real interest rate R minus Q times T. So that's very similar to the previous ones. It's just the interest rate that you borrow should be minus the interest rate you gain from the underlying asset. And and financial institution when a financial institution bought a contract, a negotiated contract, they want to watch the value of the forward contract, the contract. How much is it after time t, like sometime before the maturity? Is it what's the value of this contract? So so let's see how the financial institutions price evaluate the forward contracts. Suppose we bought a forward contract at F0 some times ago, and today is from time 0 to now, that's small t time passed. If we negotiate the same contract but opposite direct position, which will mature same as the previous, previous bought contract t period times from now, with price ft, then the value of the contract is the payoff if we saw the forward contract today at ft, discounted at the risk-free interest rate r for t period of time. So the financial institutions define the value of a forward contract by taking the discounted value of ft minus f0. So that will be ft minus f0. The contract we bought that time, we can sell it at a higher value or lower value. It could be lower, and discount it back to the previous time. Discount it back to the current the time at time t. That will be the current value of the contract. So and this formula can be applied to what we just saw for previously for the pricing of forward contract and investment contract, where we can just apply the so ft times e to the minus rt is just st. You see in the formula 1. So that will become this one in that case. And for investment assets where it produce income, then the current value of the forward contract will be just when we times ft times the e to the minus rt, we get the inner side, which is the bracket here. So ft becomes this one, and then minus f0 times e to the minus rt. So that's how financial institutions evaluate the values of the contract. So that's I want to talk about today, about future market and forward market and pricing of those forward contracts. I hope you like it. Bye, everyone.